Manish Gupta, Senior Director at Crystal Rating, is here. He's analyzed industries across sectors and also the recent announcements and have taken stock of where exactly is Capex heading right now. Trend-wise, last couple of years and also from the private sector as well as from the public sector. Talk to us, Manish, what are the findings of your deep dive?
Yeah, thanks a lot, and thank you very much for having me on the show. Yeah, you're right. The Capex recovery has got extended longer than what we expected. A key reason for the same has been multiple shocks and uncertainties due to events such as COVID, geopolitical environment, and monetary tightening, and so on. But we presently believe that things are shaping up better now, and our expectation is of a broad-based recovery in industrial Capex, commencing in the second half of this fiscal. A key reason for this are some of the trends that we are seeing. Firstly, I mean, the capacity utilization level is upwards of 75%, driven by a very strong domestic demand. PLI-linked incentives, the scheme which was introduced by Government of India, is invoking investments in the new age sectors. And a China plus one strategy of some of the global companies is also stoking fresh demand. What is also facilitating is a healthier domestic financial system too. Banks have a much cleaner balance sheet and improved capital ratios now. Corporate balance sheets are significantly deleveraged, with financial leverage moving below 0.5 times as well. So coming on to our outlook on industrial Capex, we believe the industrial Capex grew by 16 to 18% last fiscal to around 5 lakh crores and can potentially grow by 12 to 15% this year again. Just to put this in perspective, average industrial Capex during the last 5-year period of fiscal year 18 to 22 was around 3.7 lakh crores and had grown by 7% on an average. Looking forward or more on a medium-term basis, our estimation is that average industrial Capex per annum will rise to around 5.7 lakh crores over the next 5 years. This itself will be around 1.5 times the increase on an annual basis. So while the animal spirits on the industrial Capex side have been the environment is coming in pretty much there, but it is still not to the potential it can be per se.
Manish, point taken, but could you highlight the industries which are leading this Capex growth? Is it those traditional sectors or are the newer verticals are the one, the likes of renewables, etc., which is leading this Capex growth?
Actually, we recently did a very deep dive analysis on something like 43 odd sectors that account for over 70% of the rated debt by CRISIL in our portfolio. And of course, this excludes the financial sector related debt. This analysis shows that the Capex activity would be broad-based across infrastructure as well as consumption-linked sectors. Of this 43 sectors, something like 26 sectors are consumption-linked, which also includes services, where we are seeing Capex levels largely surpassing the pre-pandemic levels. These sectors include likes of automobile, auto ancillaries, steel, brick and mortar retail, hospitality, healthcare, chemicals, etc. So, and remaining 17 sectors are infrastructure linked. And there we are also continuing to see Capex, which has been facilitated by the government thrust as well. We are seeing in sectors like cement, nearly 7 out of 8 cement companies have shown a significant rise in the Capex. Sectors like steel are also seeing high utilization levels and have commenced incremental Capex as well. We are also estimating that under the national infrastructure pipeline, something like 15 lakh crores per annum investment may happen over the next 2 years. And this also will crowd in private sector investment in infrastructure and linked sectors too. You spoke about the new age sectors. Of course, PLI schemes are propelling investments in sectors like renewables, pharmaceutical, textiles, and electronics. And that is going to increase in this year and the coming in the following year as well. Sectors which are not doing well are the ones which are not doing well in terms of Capex, are the ones which are export-oriented sectors, where we are expecting that Capex may come down, and which is largely on account of slowdown in global growth.
Manish, tell us how far are we from the peak gross capital levels which we have seen, formation levels in the past cycle? How far are we away from that?
I think there is a good and significant step up that has happened already. Things are moving on a better side. I think the corporate balance sheets are strong enough. If you ask me, are the corporate balance sheets or corporates stretching it high on given the strength of the balance sheets that they're having? The answer would be no. I think we are still seeing leverage levels in the large capital guzzling sectors like steel, etc., to be on a decadal lowest levels as well. So the potential for capex in some of these sectors is pretty high. But the announcements that are made so far, they have been slightly subdued. To answer very pointedly on the question that you asked, that how far are we? I think it may take a year and a half more to be at the levels that that potentially it can be for the Indian corporates.
Okay, Manish, on that note, we'll let you go. I appreciate you joining us on the show today. Shifting focus